This is Austin Real Estate Investing.
Austin Real Estate Investing.
We'll be discussing real estate investing in Austin, Texas, and bringing you experts from all different sectors of the real estate game. Your host, Jordan Moorhead, is a real estate agent and investor in Austin and is here to help you get started or to build your portfolio and explore new strategies.
Hi, this is Jordan Moorhead, and this is the Austin Real Estate Investing Podcast. Today, we've got a really special guest here for you, Kevin Bupp. Kevin Bupp has done tons of podcasts in relation to real estate investing. He's been investing since college. He's done everything in the real estate industry. And we're going to talk more about that here today. Hey, Kevin, how are you?
Jordan, I'm doing great. Excited to be here. Thanks for having me.
Absolutely. Thank you so much for coming on here. I know you love mobile home parks. It's an asset class that I really enjoy too. And we'll talk more about that as we get into things here. But for people who don't know who you are, can you tell us who you are and how you got started investing in real estate?
Yeah, sure thing. So I've been a full-time investor my entire adult life. I always like to joke and say that I've never had a real job. I was graduated high school, going to local community college, tending bar, in the evenings on weekends. In Pennsylvania, where I grew up, you only had to be 18 to actually tend bar, which is pretty cool. So, had a fun experience there for a couple of years while I was, taking classes, trying to figure out what I wanted to do with my life. And got really lucky at the age of 19 to start dating a girl, and her mom dated a local real estate investor by the name of David. And that was the start of it. I became friends with David just by, visiting my girlfriend, going over her house, and Dave and I became friends, and I got a better understanding of what it was he did, which was very different than my upbringing. I had, two working parents, very middle of the road, blue collar. Never went without, but just, it's all relative, right? You don't know what you don't know. And I wasn't surrounded by wealth or flexibility with work schedules and things like that. My mom worked like third shift so that we didn't have to, hire a babysitter. My dad worked during the day, and then that way my mom could be home with us when we came home from school, and, but it was all normal. Mm-hmm. And anyway, I got introduced to real estate by David, just being around him, and saw this lifestyle that he lived. And he always seemed to be at over my girlfriend's mom's house random times during the day, during the week, when old people were supposed to be working, right? When adults were supposed to be at their jobs. And I just thought that was interesting. And he basically took me underneath his wing to a certain degree. I guess the best way to put it is he invited me to a conference like 3 months after I knew him down in Philadelphia. And I, basically said, heck yeah, I'll go. You paid $3,000 for this. His business partner couldn't attend with them. And so I raised my hand, didn't know what I was getting into, didn't understand really what it was he did, other than that he owned rental properties, and that was his business. Joe and I went to that, and we spent 3 days together, and I was surrounded by a lot of other folks that were mostly fixing and flipping homes. They were buying beat up properties, fixing them and flipping them, or wholesaling. That was kind of the two primary topics of this conference. But what I realized is that a lot of these folks that seemingly were doing big things, throwing around numbers of, walking away with $5 and $10 and $15, $20,000 checks from doing deals, which was just a mind-boggling amount of money for me, knowing that they've done multiple deals in 1 year, right? I didn't feel as though they were much smarter than I. They just knew a little bit more than what I did about this topic of real estate investing. And so fast forward, I got back from that conference, and I knew that if I didn't do something, that this energy that was inside of me, this enthusiasm, would go away and it would dissipate. And so I basically offered my services for free to David. And the unique thing about that was he was about 25 years older than I, right? And so this is at a pivotal moment in time with technology, to where he didn't really understand technology. He fumbled around the computer. It took him forever to type emails and respond to things. Trying to get him to put together a PowerPoint presentation was painful to watch, for different deals he was trying to raise money for, or take to a local investment club or to a private investor. So I basically saw some challenges that he had being a solopreneur, and I offered my services for free in exchange for basically, just the ability to be around him and through osmosis learn what it was he did, and better understand, his business and real estate investing. So we did that. He accepted the offer, and in between classes during the day, I had classes 3 days a week, and then I attended bar a couple of nights a week. And then on the weekends, in between those things, I basically would go, either to his home office, I'd be on the field, I'd go pick up leases, drop off leases, go to Home Depot, go grab him coffee, listen to phone calls, drive him around, whatever he needed me to do, I was there to do it. And I did that for about a year and a half. And then I bought my first property. So that was
Nice.
started. I bought the first property when I was 20. Um, Leveraged what I knew and some of the relationships I learned and met through David. And then that was single family back then. I didn't reinvent the wheel. I just really modeled what he showed me,
Mhm.
which mostly was just buy and hold. He was a buy and hold investor. I did learn very quickly that the $8,000 I used from Tending Bar to buy that first property, along with a private loan, um, holding that home as a rental property, which I rented it, and I realized very quickly I was out of money. It's going to be a long time frame until I had enough money to actually go buy a second property. And so I shifted the model slightly, started wholesaling a couple
Mhm.
properties, try to keep one, wholesale two or three, keep one. And that was really the start of it, and fast forward, I've owned hundreds of single family rental properties, hundreds of apartment units, just about every other type of commercial real estate. I kind of dabbled in retail, office. I still own some industrial today. I own medical office, assisted living, but really today where most of my time is spent, almost actually all my time is spent in two verticals. And it's mobile home parks and then parking investments. So like those are really what we spent most of our time the last decade in, and that's where we focus all of our energies. So that's 20 years now. I guess a little bit more than 20 years I've been doing this, and it's been a fun ride.
Hey guys, this is Jordan Moorhead here, and I wanted to ask if you could do a huge favor for me. If you could go leave a review for this podcast wherever you're listening to it, that would really help me get this into the hands of other people that are interested in information about Austin real estate investing, and I'd be able to help more people. Thanks, guys.
So you started with single family investing. How
That's
long were
right.
you investing in single family properties?
Yeah, from about I'd say 2000 to I guess leading up to '08.
Mm.
I think I bought my last single family property in '07, or last couple of single family properties in '07, and that's when things were starting to teeter a little bit. And
Mhm.
but in 2006, I got introduced to multifamily just literally by accident. We were never looking for it. I had a couple groups I knew that were local in the just south of the Tampa Bay area, where I'm based out of, that we're seeking some capital to do a couple multifamily deals, and I had a good bit of excess capital, and so I literally invested in a number of multifamily investments, just to put money to work,
Mm.
and so like I kind of got a little taste of that while I was still buying single family, and then when I really when single family started wavering a great deal here in Florida, and then ultimately in '08 the crash happened. I really did a lot of self reflection and realized that there were just a lot more efficiencies in the multifamily stuff than that of what I had been doing. I wasn't trying to reinvent the wheel. I just was doing what I was comfortable with, but I never took a step back to realize that there were a lot of inefficiencies with what I was doing in my business model.
Mhm.
So when I went to rebuild everything, that's really what took me into the commercial. I started looking at other ways to scale in a larger way, and not just buy one property at a time. And then again, fast forward to mobile home parks. That's what really sold me on mobile home parks. It's basically multifamily, but back when I started buying it, it was an unknown asset class. It didn't have all the claim and all the fame that it has today. And we could get phenomenal returns on an asset class that other folks weren't looking for. So it was kind of like the diamond in the rough. And it's still a great opportunity today. Just I wish I would have bought everything. I wish I would have
Oh,
bought every single
sure.
mobile home park I came across 10 years ago.
It's always shoulda, woulda, coulda type of
Yep.
deal. And
Yep.
it's single family. I think that a lot of people find out. And I was talking to a mom and pop mobile home park owner the other day, and she said when I had an AC unit go out, it would kill my cash flow for the
That's
year
right.
on a single family deal. So yeah, having that scale sure helps a lot. So how'd you get into mobile home park investing? I know you kind of found your way into it, but was there anything specific that started your interest in mobile home parks?
Yeah, it's funny because it's a great question because it's one of those asset classes I had never considered.
Hmm.
Somebody owns it. It's just I'd never met anybody. I never, knew none of the investment clubs I attended. Nobody there that I knew of owned mobile home parks, and so just none had ever come across my desk as an opportunity to look at as an investment. And so I just never considered it. However, I was in the rebuild stage, like 2010 going into 2011. I was trying to figure out what I was going to do with the second phase of my life. Went through a number of bumpy years during the financial crisis, and wanted a more efficient way to rebuild things. And I thought it was going to be multifamily. Like I pretty much had my mindset on multifamily because I felt like that was a way to scale more efficiently, and it just not necessarily have to put as much work into buying one property at a time, and be able to, scale much quicker and actually get some staffing underneath me. Like, it's very difficult to run a business. You always had that pivotal moment. I had like 35 properties before I hired anybody, and I was
Mhm.
running around like crazy. Like, I was doing everything, but I couldn't afford to hire anybody until I got to a certain scale. While I was with multifamily, you could very quickly get there and actually start, having the funds to actually hire staff and build out the infrastructure that you don't have to necessarily do everything. You can create some flexibility and freedom in your life. So anyway, I thought that was going to be the path. And during that exploratory phase, when I was trying to reinvent myself or figure out what that was going to look like, I was introduced to a gentleman by the name of Randy, and Randy was a ex-banker. He'd retired from commercial banking. He'd been in it for 30 years, and Randy, he used to do a lot of agency loans for the mobile home park sector, and he had a lot of clients down here in Florida. That his story to me was that, like, I was on the wrong side of the P&L for many years, and I realized that my clients over, the last 15 years I was writing loans were just absolutely killing it in this, mobile home RV space. And so he kind of, made a pledge to himself that when he retired, he was going to go. His retirement was going to be, I'm going to go buy a couple mobile home parks, and he did. And so anyway, I was introduced to this guy Randy, had lunch with him, and during that 2 hour span of time, I didn't have an interest in mobile home parks. I was just going to meet this guy that was a banker and, really smart guy, was well connected in the local area. And he spent 2 hours selling me on all the merits of mobile home parks, and why I should really consider that asset class and not multifamily. And he just went on and on and on. He intrigued me so much that I completely shifted my mind of multifamily being the way to rebuild, and really shifted my focus to mobile home parks. But the problem was, back then there weren't podcasts. There wasn't hardly any literature on mobile home park investing. In fact, there was practically nothing. There was no books written on it. Um, if you knew someone in the industry, that's how you found out about it. But if you didn't, you didn't, right? Like, there wasn't a lot of associations. There wasn't a lot of a presence. And so it was very mom and pop-ish. But I spent the next year literally looking for a deal. I made a lot of offers, went and looked at a lot of properties, got cold feet a number of times, but ultimately
Yep.
bought the first mobile home park back in late 2011 up in Atlanta, Georgia. This is during the time when lots of distress still. This was a REO property, and
Oh,
literally owned it up until I guess it's probably been close to 3 years now, 2.5, 3 years. Sold it, but so owned it for quite a long period of time. But bought that first one. Very different than what we buy today. It was 34 units, all vacant. Had been
all vacant?
vandalized. Yeah, it was a long story, and I won't go into it here. But basically, what we acquired with this 34 unit property was 34 homes as well. All these
Oh.
homes, the old owner had basically redid this park, went and bought some 3-year-old FEMA homes from, I forget which hurricane, brought all these in. So they were all newer homes,
Mhm.
but he basically he basically took a bunch of money out, took a new loan out to buy all these FEMA units and bring them in, but they continue running it like a slumlord, like he had been, and
Oh.
basically just lost his shirt on it. And so, long story short, we took it over, had been sitting vacant for a year and a half. The servicing company never turned off the water, and, Atlanta doesn't get many freezes, but they do every once in a while in the winter, right? And so, like, there was broken pipes squirting everywhere in these units. That
Oh.
all the AC units had been stolen, windows broken, rotted subfloors. But the bones were good on these homes. The same way we bought this thing, all vacant homes,
Man.
and basically went to work. And used a little bit of money I had that I hadn't lost during all the crash and all that, and
Mhm.
turned it around over. It took about 14 months to stabilize it, and then within 18 months we did a cash out refinance, got all of our money back out, and did it again. Bought a park. The second park was in North Carolina. Bought another park, bought third park, fourth park. Anyway, just basically saw an opportunity to
Mhm.
just continue, you know, pouring our money back in, our investment back into other mobile home parks and good markets and good growing markets. And so that was the start of it. And then it really turned into what it's in today. And, so the mobile home parks, the returns were huge. I saw an opportunity in a space that a lot of other folks weren't spending their time. And I would say what came along with that were challenges, though, that don't exist today. Back then, it was very difficult to get financing. I'd have to call. I remember making a map of all the banks in the local area and calling around and literally, banging my head against the wall to sell them on this amazing property that we're buying at a 15 cap or 16, whatever it might be, like a
Yep.
crazy cap rate. And most of them just don't understand the business model. And it's a very simple business model, but most banks didn't understand it. Today, it's a very different world.
I talked to a banker the other day that said, well, you can only sell them as mobile home parks. They could never be redeveloped into anything else. And I said, you're got to be kidding me. The city would rather it be anything else than this.
That's right.
So they still don't get it.
Well, not even that, just the business model itself. I think in their minds, a lot of banks that don't get it, there wasn't a lot of data. There wasn't a lot of institutional data available either. And so I get it. Like they didn't have a lot of resources to rely upon as to, how safe of an investment. So I think in their minds, mobile means it can be moved, and like the chances of the collateral or the collateral meaning, the income, the home that's creating the income on the lot, there's a chance that goes away. And as you and I both know, that just doesn't happen. It happens across our entire portfolio. I guess we've owned probably north of 6,000 lots now in the past, 10 years. And no more than 15 homes of that entire time have ever moved out of our communities. And most of the time when they do move out, it's because maybe just that individual happened to have a piece of family land somewhere, and they moved their home to a piece of land that they owned or just bought. But that doesn't happen often at all. It's very few and far between. And so, anyway, it just doesn't happen. It's a risk that doesn't really exist. But so that's how we got into it. Fast forward today, and we own parks. I think right now in 13 states. We've owned in, I think it's mainly like 23 states, throughout the country, mostly all red states, with Maryland being a little blue. And we have historically owned in New York, no longer, and we do own in Minnesota, which is, I guess you could say, is a predominantly blue state, but mostly red states.
Certainly,
we like red states like Texas.
Yeah, it's easier to manage rental property in red states. That's for sure.
We're very specific though of where we, it's got to be the red part of a blue state, right? Like we own in Illinois, and Illinois is mostly viewed as blue because of just Chicago is so densely populated, but the remainder of the state is all red. And so we own there, and it performs quite well. And it's very easy, tenant landlord policies that are in favor of landlords, and so. But it's case by case basis, we don't just draw a broad brush stroke across any state, except like New York and California and a few of those others that are just like, no, don't go there. It's not worth the headache doing business there.
So is that no rent control, no matter what type of deal?
So New York is statewide rent control, and it's very aggressive rent control policy. And so it's very difficult, and we sold after that happened. We got out of that state and just moved on, and it's very difficult. It's 3% a year. You have the ability to get 6% increases, but you've got to basically get approval from the community to do so. And what are the chances that the community is going to give you approval to double their rent from what would have been 3, right? So like I think it's a slow dying. These things are going to slowly die in the vine, because 3% really doesn't even keep up with inflation, and it doesn't allow you the ability to actually put aside future reserves for capital improvement projects, roads, infrastructure, things like that are going to be big ticket items. And so I don't know how that looks in the next 10, 15, 20 years, but in my mind, it doesn't look good. Now, on the flip side of that, like Oregon's a state that's got statewide rent control, but it's not as egregious. I think it's 7% plus CPI. So call it 10%, that's, while I still don't like the policy around it, that still gives investors some leeway. I mean, you could still, find your way around inflation, keeping up with inflation at 7% plus CPI.
Sure. And I think, but that assumes you're at or close to market rents too, right?
Yeah. Have you wanted to be part of GoBundance, the tribe of millionaires, but just haven't hit that millionaire status yet? Well, now you can, not even being a millionaire, by joining our new program, GoBundance Emerge. My name's Jamie Gruber, creator of GoBundance Emerge and member of the GoBundance community. And now you can join GoBundance.com/emerge, GoBundance.com/emerge. Use code Jordan for $100 off this 12-week goal-setting program and mastermind that'll propel you to being a whole life millionaire.
So you got to take that in consideration. That's right. And there's other nuances with some of the, I don't know how it's exactly how it's written in Oregon, but like a lot of times, like if you turn a unit, if a tenant leaves, you can reset it to market. Like there's other things like that exist in some of those policies that allow folks to kind of not work a loophole, but just over time they can create a strategy around maybe how to get the market over a span of a number of years, not just by doing rent increases on the existing tenants, but if you have a natural attrition which occurs, maybe you can kind of factor that into your overall business plan.
Sure. And what's your perspective on rent raises when you're purchasing parks? So this is a bit of a selfish question. So I've always heard, 50, 75 is kind of the highest you want to go. What's your thought process when raising rents on a park? Because a lot of these parks you'll buy and they'll be half of market or less.
Yeah. I don't know if it's an actual dollar amount more so
Mhm.
than it is a percentage, but then also there's other considerations like how much, like, are you buying a park that literally has, crater deep potholes in it, high crime, street lights haven't worked in 10 years. I mean, like, it's a complete disaster. And you're going to go in and put $1 million of capital improvements into it, where, maybe the market's $400 and maybe the current lot rents are 200. In that instance, I don't see that it's out of the question that if you're going to drop that kind of coin and literally turn that property from a 1 star to a 3.5 star, to bring rents up $100, which is seemingly it's a massive increase, right? If you just
Mhm.
look at just from the pure perspective of like from a dollar perspective, percentage perspective, it's big. It's a big whack, but the improvements that you're bringing to that community and to those residents that live there, I think warrant that. I think the biggest issue occurs when, and I think a lot of the ones that have gotten a lot of headlines are communities that are rough like that. The market surrounding it, maybe the comps, they're a lot nicer, but so you can use them as comps, because maybe the market's full, there's no vacancies in the market, and so they're not going to leave.
Mhm.
If you go into it with that mindset, and you're not going to make the improvements. You're just going to go and you're just looking at the total return. If I just raise rents, don't do very minimal to no capital improvements. I think that's when you run into problems. Like, there's no justification. The only justification you have is that the old owner didn't keep up with market. Like, that's it. Like, that's the only argument that you stand on. But I think that if you're going to go in and make the community a better place for all those that live there and make it a better living experience and have justification to do so, then I don't know if there's really a dollar percentage amount associated with it. So I'll give you an example. Like, we actually just the call I just got off of, I was unfortunately late for this podcast. Apologies. We're walking through a deal that we're in contract with, and it's it's a very nice community. However, there's some deferred maintenance. Not a ton, but it's a large community. It's a 500 space community.
Oh, wow. That's a big
Current
one.
lot rents are roughly $488 a month. The market is between 750 and 850, for this quality. And there's it's a big community, so it needs a good bit of road. We're going to spend about, I think our capex budget's about 1.7 million. So we're going to redo all the playground equipment, and it's a big playground. It's massive. Lots of road work. There's a lot of trees, which make the community gorgeous, but they haven't kept up the trees, which become very problematic and very expensive. If you haven't trimmed things in 7-8 years. So we got a pretty healthy budget in there, but even then, yeah, one could probably argue we could probably go in and nothing would happen. We could probably go in and raise rents $150 out of the gate. Folks would be upset, but no one's going to leave because they're still way under market. We could use that as a justification that we're making things nicer, this, that, and the other. But I wouldn't feel good about, like, we're making improvements, but it's already a pretty nice community. I don't feel like we have justification to really go in and literally double the rents right out of the gate, even though we could. And so our plan's more of like it's like a 5-year plan. I think our first year we have budgeted for, I think it's right at like 14%. And then it goes to like 12% and then 11% for 2 years and then whatever the remainder is. But like it's a scaled out approach. We have other CapEx projects in the works for not just the first year, but we have it kind of drawn out over a 3-year span of time,
Yeah,
kind of
sure.
priority projects, secondary and tertiary projects as far as priority. Um, and so I know I didn't answer your question directly. I don't know if there's an exact formula for it. I think
Mhm.
it's what makes sense for that community, and how would you feel if you went and did a town hall with the residents of, here we're new owners, we're going to do this. Would they come at you with pitchforks, or would it just be one or two that are just disgruntled, because you're always going to have those, but the rest are like,
Sure.
I don't like it, but it makes sense. I'm
Mhm.
excited for all the positive things that you're going to bring to our community, right? And
Yeah.
I want to know that we can walk away knowing that we've made a positive impact on 99% of the community, whereas we're never going to make that last percent happy. They're going to be, even if it was a $10 rent increase, they'd have still been, perturbed and upset about it. So,
Oh, yeah. And a lot of these people have
Been
been,
subsidized for so long by mom and pop. If
yeah,
any sort of rent increase is too much. But
that's
yeah,
right.
just curious what your perspective is on that. And that answer made a lot of sense. It's really a deal by deal basis. And what sort of improvements you're doing. If you're spending $1 million, yeah, you're going to need to raise the rate a little bit. So Kevin, I know you invest in mobile home parks and parking lots almost exclusively now, correct?
That's correct. Yeah.
How did you end up there after doing everything else? I know you've kind of talked about your trajectory investing. Parking lots is pretty unique. I don't know many people that do that.
Either did I.
Oh yeah, that's good. Yeah, that's
isn't
great.
Isn't that how the story goes though? Like I said, just like with mobile home parks, I just by happenstance was having a conversation. I was intrigued by the business model. Kind of the same thing goes with parking. We all know that somebody owns it. A lot of parking is owned by municipalities. They own garages and lots in different respective areas of a city or town. But there's also a lot of privately owned stuff as well. And I happen to have a guy on my show. I love bringing unique guests on every once in a while. They're just kind of like out of the box, things that I don't know much about. And parking just happened to be it. And I brought a guy on the show, I think probably 6 years ago, maybe 7 years ago, that was a parking lot broker, but he owned also a pretty healthy portfolio of parking lot investments. But he was like literally one of like 4 brokers in the country that was their specialty, was parking investments. And I brought him on the show, interviewed him, and once that interview was done, I was so intrigued, and I literally I called him up and I flew him out to Tampa to spend a day with him. I brought him in like, hey man, like I need to learn more about this. I've got so many questions. And then we just dug deep. Like I was still once I learned about the business model, I saw a lot of similarities with mobile home parks, a lot of mom and pop owned parking assets, a lot of antiquated operational strategies still existed. Like a lot of mom and pop parking lots and garages didn't have the newest, latest, greatest technology, or didn't have any technology at all. Like they didn't have dynamic pricing models in place. They didn't trend with the supply demand factors with events happening or special holidays and things like that. And so I just saw an opportunity there. And long story short, we researched the industry for about 3 years before we ever bought anything. We went to there's a number of national associations. We'd go to their annual events. We'd go to local events. We meet other parking owners and operators. And we finally bought the first parking asset. And we didn't buy until 2020. In fact, pretty happy that we waited a little bit because there was probably a number of parking assets that industry took, depending when they were where they were located. But there's certain cities that obviously shut down for many months or even years. And the parking industry went through some pain in very very targeted or concentrated regions. And so but we bought the first asset in during the midst of COVID, the beginning of it, in mid 2020, and have been buying ever since. In fact, most of the things that we bought in 2020 and 2021 actually thrived during COVID. They were in areas that weren't on lockdowns, like coastal North Carolina, coastal Florida, Phoenix, Arizona, areas that people were like migrating to get away from the
lockdowns
states.
And tight restrictions. Yeah.
So it's funny if you look back at our numbers, if you look back at just the historicals, like you'll see literally really steady and then a ramp up and then back to stabilization again after COVID. And so there was a spike during the COVID years.
We know that well here in Austin. We were a recipient of a lot of people fleeing all sorts of other areas to come to Austin versus that stuff. So Kevin, what do you look for in, let's say, a mobile home park deal, but then also a parking lot deal? So let's talk about both of those. So if you're looking for a mobile home park deal now, I know you're probably looking on the larger end, maybe 100 plus.
100 plus, yeah, 100 plus. And we'll consider smaller if it's near an existing asset. We just closed, or I should say, we're closing this tomorrow on it's 93 sites, but it's literally 20 minutes away from a larger asset that we own. So we'll look at smaller if it's near other existing communities that we already operate.
Okay. So when you're looking at a mobile home park deal, or you're looking for mobile home park deals out there, what are you specifically looking for?
Yeah, I mean, first and foremost, the market is the key indicator. That's the one thing that we can't change. You can't take what seemingly looks like a good deal from maybe it's a going in cap rate, or maybe it's an opportunity to double revenue just by increasing rents because they're half the market, whatever. It's like you can fix all that. You can fix a bad tenant base, but what you can't fix is the market or the part of the market that it's in. And so that's first and foremost for us. Like it's got to be in a thriving area that's got a growing population, that's got employment diversity. It's got to have a decently robust population. It's got to be in a good school district. It's got to be in the part of town that people actually want to live in. Even folks that are on lower incomes want to send their kids to good public schools. They don't want to be in the the worst school district in the area. So those are first and foremost, because we know that if we have all those basic fundamentals, we could fix everything else. It's got bad infrastructure, bad tenant base, roads are broken up, any of that stuff, bad people living there. I can go in and fix all that up. I can get rid of the bad people, bring in new homes. And I know that there will be plenty of good people waiting to live there because it's in the good part of town. So that outside of that, we're opportunistic, just like everyone else. We like to get in and know that we can make money on the buy and that there's problems that we can fix, and then ultimately increase revenues over time and ultimately turn a significant profit at the end of the day by fixing things such as, again, operational things that I just spoke to, just poor operations, poor management, poor collections, bad tenant base, high crime. We can fix all those things. We can reduce payroll expenses. We can reduce repairs and maintenance expenses by, fixing or replacing infrastructure. Again, at the end of the day, hit mid to high teen returns on our investment, and many times much higher than that. But we're looking to turn a profit, but most of that you make on the buy. The same thing goes with parking. We like to fix things that are broken, but the one thing you can't fix with parking is the location. So we look at parking as, I want to buy an opportunistic asset that I know there's upside. I know there's value creation to be had. It just hasn't been tapped into. But the one thing that it has to be in parking, we like to call it like an irreplaceable location. So I look at parking today, any parking asset we own, its lowest value is of its current use, which is parking, whether it's a parking garage or a surface parking lot. Its lowest use and lowest valued use is parking today. But if I can make it make sense, economic sense as parking from an income perspective, then I know that it's only upside from there. And so I'll give you an example of a deal we did, a small deal we did up in Wilmington, North Carolina. It's a surface lot, great historical part of Wilmington, North Carolina, great part of town, near all the bars and restaurants. I mean, just a thriving area, but it was a small parking lot. I think it's 28 parking spots. We paid $695 for it when we took it over. It was being run by a guy, local real estate investors. He had his son operate it. His son was there. He didn't take credit card payments. He was collecting cash. His son probably pocketed half the money.
Sure.
They didn't adjust pricing for, peak times, Friday, Saturday, Sundays. They didn't
Seeing like a booth.
Jordan Moorhead here. Really quickly, wanted to tell you a couple other ways you can keep track of us. If you want to listen to all these podcasts and ask questions, the Moorhead team on YouTube is the best place to be. And then Austin Real Estate Investors on Meetup is a great place to keep track of all of our meetups we have going on.
He stood there with whatever apron on with, whatever. And
just collecting cash.
But they also didn't have enforcement. He wasn't there all the time, so they didn't have enforcement. People would stay there for longer. So it just, when we bought it, his NOI the prior year was $48,000, and we paid $695 for it. So when he sold it to us, he thought he was getting an credible deal. Like, we were buying at a fairly compressed cap rate. But we knew the market. We did some research there. Before we even closed, we had a local operator come in and sign a triple net lease with us. They owned they managed 16 other lots in the area. So they have the data points to suggest what this lot should really do per space. And we signed a triple net lease at $72,000 a year before closing. Wow. with this group. They manage it to this date. And so, that's, basically an unlevered 10 cap out of the gate. I've got to know this operator a little more over the years, and he's shared financials with me of what this parking lot really does. And you'd be blown away. I was blown away, actually. So on a normal, the last 3 years, it's averaged about $140,000 top line revenue on this 28 space parking lot.
Great.
And so they're doing really well also on their side of it. And when our lease is up, more than likely we'll have to revisit what that future structure looks like. But 28 space lot, but they've got dynamic pricing in place. They adjust the pricing, rates based on weekdays, slow times, busy times over the weekends, special events. They do valet parking for some of the local high-end restaurants. They've got a multi-pronged strategy that this mom and pop just doesn't have. And so that's a very common element of these parking operations. You can find value in introducing either a more proficient operator or just introducing technology that allows you to literally you could manage something like that literally from your smartphone now, practically from your smartphone. And there's enough third party resources that would allow you to do so, from parking
So,
enforcement to management to credit cards and things like that.
so are you doing all triple net leases on all these parking lots, or are you managing any of them, or your company managing any of them?
Our preference is that
Mhm.
if we can get a triple net lease in place ahead of time and have the economics still make sense, yes. But I will say that it's all dependent on the market. So we recently bought an asset in Phoenix, and it's still in a management agreement. And I'm glad that we kept it that way, because when we took it over, we had a pro forma built out, and we felt what we thought this could do. We have,
Mhm.
we try to go in fairly conservative, but like we've blown that pro forma out of the water, like, by like 18 to 20% every month for the last like 14 months. And so I think we would have shot ourselves in the foot if we would have gone in with what our initial projections were and actually negotiated a triple net lease with
Mhm.
another operator based on those numbers. So I'm glad that we didn't,
Mhm.
because now we know what it really can do after we've been in there operating it for a period of time. So I think there's some risk with the unknown of going in right out of the gate with putting a triple net lease in place. But in the other times that we've done it, there's been enough of a spread. Like our returns are still just absolutely stout. And you know what? If it works out well for the other operator that's leasing it from us, great. And then we know that when that lease term runs up, like
Mhm.
we know a lot more about the asset. We know what it really can do, and then we've got a little more leverage at that point in time to either put it on the management agreement or go back onto a lease, but have a little bit more clout when it comes to the lease negotiations.
It seems like it would reduce your risk quite a bit to let them run it for a few years, just so you could get some understanding of
Yeah.
it. And
Well, the trick with the lease, so our lease agreements are a little unique in that we require that the lessee provide us with pretty substantial financials and
Mm.
reporting on
Oh
a
wow.
monthly basis, because normally that's what you normally would not get.
Hmm.
Like they should have autonomy in most instances. If they're going to lease it and they're going to take the risk and cover all the expenses and all those variables, then they should typically not have to. Like they would not expect to provide the lessor with with a full financial stack and reporting stack on a monthly and quarterly basis. But that was one of our criteria. Like we wanted to know, so like we bought a garage 2 years ago, and we gave the guy a 10-year lease on it. So like that's like he's got a long runway, but
Hmm.
I want to know when it comes time for us to recap that, because we still have debt on it and we're going to have to refinance at some point in time. I want to put ourselves in the best foot forward when it comes to refinancing. And while that lease does that, if I can show the bank that, like, hey, guys, this is what our lease is at, and they've been performing quite well. They paid their payments on time for the last 5 years. But guess what? Here's what they're really making on this. So like, that your collateral is incredibly safe. In the event
Hmm.
they should abandon this lease or go belly up, know that this asset stands on its own. And so like that's why we put it in there. It just gives us more leverage when we negotiate future debt.
Sure. No, that makes a lot of sense. So it sounds like, and correct me where I'm wrong, the most important thing to you when looking for a mobile home park or parking lot deal is location, but
Yeah.
just to specifically the metro, the areas in the metro, and probably more emphasis on that with the parking lot.
That's right. Yeah, absolutely more emphasis with that in the parking lot. I mean, it's all very important, but the parking lot piece of it, it's you know, I wouldn't say that most mobile home parks are located on irreplaceable plots of land. They might be in a good
Hmm.
market, but they're not like in the core of downtown. They're not in an area where there's literally not another vacant parcel of land available. Like they're normal in the outskirts, in a suburb. And so little different approach that we take with the parking. Like it's truly got to be in an irreplaceable part of the town or municipality, whereas mobile home parks just have to be in a good market, generally speaking.
Sure. Yeah, I'm just thinking about mobile home parks here in Austin. They're, around downtown, but none of them are just the core central business district area of downtown, that type of stuff.
And
So,
if there were those, they probably got redeveloped
yeah,
15, 20 years ago.
there may have been some. Who knows?
Yeah.
Yeah.
Yeah, no, I
Uh,
mean, there's a lot here in the Tampa Bay area that, in fact, one I used to live right around the corner from. It was a very large 55 plus. It was a very nice community. It was probably 600 sites, and I just happened to know the developer that redeveloped it. He bought it. It was I think a 15-acre plot of land, and he's a retail developer. And this is, call it 15, 16 years ago. He redeveloped it into a Coles and Total Wine as the primary anchors, and then a
mm,
Panera Bread and a bunch of other ancillary retail groups, and then some out parcels, and he did really, really well.
Oh yeah.
But it was it was a phenomenal area. I mean, much higher and better use as what he put in there than that of a mobile home park. At least I don't know if that'd be the case today, though. Interesting enough, mobile home parks have gotten such traction, and I don't know if the justification would have been made, especially where it's a great retail location. Still, like, it just kills it. I mean, it gets a lot of traffic. I don't know what the car counts are daily, but I bet you it might have reverted. Looking back,
Oh really?
mobile home parks weren't as sexy then. Rates weren't as high. They didn't trade on the type of cap rates they trade on today.
Mhm.
Retail was still very stout. Wasn't as much threat from e-commerce on Amazon. And while it's still a thriving retail center, my gut would tell me that it actually probably would carry a higher price tag if it was back in its original state of a mobile home park, knowing the location. It just, that's how I feel. I'd have to look at the economics and figure it out, but that probably doesn't happen all that often. But in that instance, I would probably argue that it would be worth more as a mobile home park.
Do you think a lot of that's because of social media? So, like your podcast, the Mobile Home Park Investing podcast, because the affordable housing crisis is so bad, because finding a good return has become so difficult. What do you think is the biggest driver of the rise of mobile home parks?
I think it got institutionalized. It was never on the radar of institutional investment groups. They were always just the kind of major food groups in commercial real estate, like office, multifamily, retail. Just the normal industrial. And there weren't really. I mean, there was only 3 publicly traded companies 10 years ago in the mobile home park space, and there was no institutional capital in the space at all. And it was just a 95% owned by mom and pops and a very small sliver owned by these, publicly traded companies. And it never got the consideration of big institutional capital groups. And so with that being said, it didn't trade at premium cap rates. It didn't carry, 5 and 6 caps. It traded at 8 caps or 8.5 caps. And so when the institutional capital started pouring in, seeing the opportunity and just seeing, there were some real data points now being tracked on the asset class, that obviously drove prices up and drove cap rates significantly down. And so it just became institutionalized, which is part of the consolidation process. Now there's still a lot of mom and pop owned mobile home parks, but
Mhm.
Going from 95% mom and pop now to probably, I'm just throwing numbers out, it's probably only 55% now that are mom and pop, right? Like, it's very quickly becoming consolidated. It's kind of like self-storage, what self-storage was 20 years ago to what it is today. I mean, like, it's very institutionalized today. Multifamily was the same way, 25 years ago. It wasn't an institutionalized space, and now I think 90% of the communities that are 300 doors or larger are owned by an institutional operator.
Mhm.
So I think that's ultimately what changed in a major way. It was interesting when we started buying mobile home parks, back in 11. It was very common. They wouldn't even trade on a cap rate. It's the craziest. I mean, cap rate would be used as one metric, but very often I would find that they would, sellers would say, "Well, what do you pay? What are you paying per lot?" And I'm like, "Why is that even relevant? That doesn't even make sense." Like,
Yeah.
and so they would literally, that was the mentality of, well, what did that park trade for per lot down the road? Don't even take consideration what lot rents they're getting. They might be getting $500 a month lot rent versus I'm getting 250 or vice versa. They would
Mhm.
go. It'd be like, what did it trade on per lot? And literally, I'd see brokers marketing on their OMs. They would specifically highlight, the price per lot, and they would use that as the comp, and it wouldn't be cap rate or it wouldn't be IRR or anything like that. And it was just baffling to me. It's such an antiquated way of looking at from a valuation standpoint. So it's just become institutionalized. That's all. It's a good thing. It's a good thing. It's bad in that it makes it much more difficult for us to find deals that provide returns that they might have historically done. Right.
Mhm.
We could still do it. We got to work a little harder to find them and to create the returns. But on the flip side, it's been beneficial because now with institutions coming in, we've got a better exit strategy. Whereas,
Mhm.
we built a portfolio of, call it 100 million, 200 million, 300 million of assets. Years past, there was no one to buy it. You'd have to
Mhm.
break it up to
Yeah.
sell it. You'd have to sell them one by one by one. Now there are plenty of groups that can take down that big of a portfolio, and you'll get a premium pricing because of the consolidation factor of it. So it's good and bad.
Again, more question just out of curiosity. What are the average going in cap rates on 100+ lot parks that you're seeing right now? And then when you're turning around and selling to institutional capital, what cap rate is that happening at?
Yeah, I could speak to like Green Street data and like that. That is the most institutional, high quality data that exists. But mobile home parks are trading at the lowest cap rate of any other asset class still today, even with
Really?
where rates have gone. Yeah, it's. I think right now I haven't looked in a couple months, but it's in the mid fives, the average cap rate for and they don't look at like they're not looking at transactions that are occurring in like rural Kansas and things like that, right? Like they're looking at the major markets across the country, and that's where they're getting their data points from. But yeah, it's sub 6% cap rates, negative leverage in many cases. But again, a lot of these parks are still there's still an opportunity because they're still significantly below market rents. There's mom and pop operators still. There's some inefficiencies that can be levered there. But yeah, it's absolutely crazy, and there's plenty of still buyers out there. So which again creates difficulties on the buy side, but if you can find opportunities, and they still exist, there's a really healthy exit available with someone that's willing to pay a premium pricing, and that has the capital and the wherewithal to do so.
Absolutely. And I think so I listened to your podcast, Real Estate Investing for Cashflow. I've listened to your mobile home park investing podcast. It seems that most of the acquisitions you do are off market. Is that
They
right?
have been historically, yeah. I would say that up until probably about 2 years ago, like 95% of what we had done was all communities that we direct to owner. We've been maintaining relationships with them for many, many years.
Mhm.
Basically, just taking the role of a broker, right? Like we built this, our database over the last decade plus, and have just maintained it within the CRM with notes, and we follow up with folks on a regular basis, set reminders to do so. So a lot of what we bought has historically been from those efforts. I will say that in the last 2 to 3 years, there's been way more brokers that have come into the space, and that it's good and bad, right? It's a good thing because now there's more people on the hunt and more. I guess the timing. It's all about the timing. Like I might make a call to a guy, and then he's not ready to sell, but 3 days later something happens, and I don't call him for 3 months, right? And but
Mhm.
maybe a broker calls in 3 days, and that opportunity still becomes available to me, whereas it might not have otherwise. And so, but the challenge with a lot of brokers getting into this industry, whereas when I started, there was maybe 10 or 15 brokers across the country. Now there's hundreds. I can't even count how many. Is that there's I guess pricing exploration what's created by these brokers, and value exploration with owners that might not have been fully privy to the value of the properties. But even on top of that, I think a lot of brokers, just there's so much competition there in order to get a listing, they might set the bar incredibly high
Yeah.
and set expectations too high just to garner the interest of that what would have been a seller, maybe not a seller, but like, hey, I'll sell it at the right price, right? And so that's created challenges going off the market because a lot of these folks that we used to talk to, they weren't getting called by 100 brokers in any one given year. Now they have, and most of these folks have put really high numbers in their brains, and
Mhm.
it's really hard to be point to point with another seller and try to justify to them why their property is not worth as much as what maybe a broker might have stated it was worth. And so it's easier a lot of times now in those instances to actually have a intermediary, a broker involved in the middle, set expectations appropriately, and then play the middle guy. And that way, it's somewhat of an unbiased opinion of what this thing's really worth, or what the market says it's worth. And so nowadays, I would say that 70% of what we buy is probably a result of broker relationships, maybe
Oh,
not on
really?
market stuff, not on market stuff, but I mean, trying to think what last on market property we bought was last year. But the last two that we've purchased have been brought to us by a broker. We paid,
Mhm.
their fee, but it wasn't on market. It didn't get, mass market or anything like that. It was just really, they made a cold call. They got the timing right, brought it to us, and then we ultimately closed on it. But, and 30% are still us from our prior relationships with, different owners that have owned for many, many years that we just keep in touch with. So yeah, it's shifted quite a bit. It's just, again, we just determined that, what is the most efficient way for us to get deals done? And we just found that we were banging our heads against the wall doing what we
Sure.
used to do.
Mhm.
Because again, these folks are getting called now. We're not special. They're getting called by so many people on a regular basis. And again, especially during COVID years when rates are really low, I mean, they still had this, grand vision of like what an offer they might have received, 3 years ago, what that looks like. And they've got it stuck in their brain. And it's very difficult for me to whittle them back down to reality. And much easier sometimes to have someone as an intermediary or broker do that for them, get them their expectations, let the market teach them what it actually should be than what they think it is. And so,
That's
yeah, times have changed. Times have
but
changed. But I do like to hang my hat on that. Most of the stuff we bought over the years for a very long run, for a good 10 plus years, was all off market, and we've done some incredible deals during that time.
yeah, I know it's a lot of work too. I know you've put a lot of work into
Yeah.
your off market strategy, and I like that perspective with brokers too, is you kind of get them to bring the seller back to reality for you and takes a lot of the work out of it for you. So when you're buying from brokers, are they bringing it to you around a price you're paying for it? Or are you saying, hey, it's not worth that, you need to get it for 20%, 30% less? Is that actually working out for you?
Yeah, I mean, like, so it's funny. It's a great question because I've had 10 of these conversations in the past 2 days with just a handful of other brokers that bring us stuff on a regular basis. They'll give me some basics. Hey, Kevin, what do you think of this? Give me the address, how many lots, what the rents are, whatever else they know about it, utility arrangement, who pays for what. And I always ask, like, what if they don't give it to me, what's the target pricing? Like, what are they seeking on this? And I can just do quick back of the napkin, and I'll just go back. I'll say, before we waste any time, like, I don't even have to give me financials on it. Like, don't even ask for that, because I think they want 17 million. I just wrote an offer earlier today. They want 17, and realistically, it's worth somewhere between by 13 and 14. I went in at 13 because I just haven't seen financials on it. But
Sure.
really, it's way off the mark. And so, but he came back. He's like, well, tell you what, write an LOI, and let's see what happens. But most of the time, he'd come back and be like, based on my conversation, this guy's not really even a seller unless you even got close to his number. And so I wouldn't waste your energy on it. And then we'll move on,
Mhm.
but I'll kind of go with their guidance of what they think. I'll write a formal offer if they want to see one, and let them like go to work on it and let them go to bat. But I kind of allow them to give me their gut check of, they had the conversation with the seller and they know whether or not it's worth their time or energy or effort. They want to get paid as well. They don't
Sure.
want to spend,
Yeah.
spin their wheels. And so, like, that's normally how a lot of these things go. It's just an address, some basic information. Hey, I just got off the phone with this guy as I'm making my 100 calls today. I had a conversation with him. He gave me some pricing guidance. Here's what he gave me. Are you interested? And a lot of times I'll look at the address and I'll just look it up on Google Earth and be like, wrong part of town, wrong
Mhm.
area, really junky. Just a litany of things, right? Could be a reason why we're not interested. But if we are, we'll always give feedback, and I think that's the important thing. For those of you out there like that are looking to work with a broker or brokers to find opportunities, like, provide very detailed feedback and do it quickly. Like, in fact, I don't know if have you ever used Loom before? So normally what I'll do is I'll create a Loom video.
Oh, really?
Real quick. I'll literally just like get on Google Earth as they say, send it to me. I'll get on Google Earth with the address. I'll look at it. I'll kind of scan through the area. I'll say, I just, hey, John, I just appreciate you sending this. Don't have an interest for a couple of reasons. Number one, like, it's, the layout of these homes in here, like, the lots are really small. I don't think we'd be able to bring in new homes in here. The lots are too small. So if we lose some of these old homes, like, we're not gonna be able to bring in new homes, or we're going to lose lots. Like, if it's a 100 space park, we might end up with 80 when it's all said and done. Or
Mhm.
maybe it's we don't like the market, or just the basic economics. I'll do like a quick back the napkin on the screen. Literally, like, they're asking this, like, help me understand where this $3 million gap is. I don't know where it's at. I'd be more than happy to write an offer, but just wanted to give you some quick feedback as to kind of where my head's at on this deal. Would love to buy it, but just don't think that we can meet their pricing. Appreciate you sending it. Look forward to doing a deal together here sometime soon. Like, literally, like 3-4 minutes, send it to them. It's personalized. And it gives them immediate feedback. It's in the buy box, not in the buy box. If it's not, why?
Yeah, no,
I
it
think
helps them think of you when they have the right deal too.
Yeah, yeah. I think that it adds a personal touch, and it's just they're looking for feedback, and that way a good broker will start documenting all that feedback you give them and say, hey, I know Kevin likes this, doesn't like that, and like they'll start creating their own matrix of like, what should I even be sending Kevin's way, because I don't want to just send emails to send emails, and it builds a connection as well. Again, brokers, they get paid by getting deals done, and they want to know that the person they're sending something to is actually going to not just give them feedback, but also when the time comes and the right deal comes, they're going to get the deal done. They're going to transact and get it to the closing table.
Awesome. Love that. Kevin, you've got so much experience investing in real estate. A question I like to ask everybody that comes on the podcast is, what's a mistake you've made investing in real estate that you can tell others so they can try to avoid that? So what's the, whether it's single family house, mobile home park, parking lot, it's a big mistake you make where you say, I'm never going to do that again.
Make sure to come check out our meetup, Austin Real Estate Investors, here in Austin. That is every second and fourth Thursday of every month. We would love to see you there. Again, it's Austin Real Estate Investors, and you can find it on meetup.com.
That's a great question. I could probably use these last couple of years with rates increasing, and then prior to that with COVID, the COVID frenzy that happened,
Sure.
with pricing just going out of whack. I wouldn't say I got caught up in the frenzy back in 2006, 7, and 8, but one could argue that I did, right? We bought a lot. We were buying things that seemingly kind of made sense from we're going in, we're buying it at 70 cents in the dollar. But I was always touted to be a cash flow investor back then, but I got stuck in the mentality of just buying things at a discount, even if they didn't cash flow, right? Like that's a fool's game. And but hey, I'm buying it at $70,000. It's worth $100,000. I can tell you that didn't make a hell of a difference at all when values started going down, and ultimately, these things became upside down in a matter of like 12 months when the crash started really unfolding. And then on top of that, they didn't cash flow anymore, right? And so, like, fast forward, talking about getting caught up in the frenzy. One of the biggest probably internal struggles we had as an organization, it's myself and one other partner, business partner, Brian Spear. He's mostly on the capital raising side. And as we all know, there was a lot of liquidity flowing around the marketplace in 2020, 21, 22.
Oh,
Just
yeah.
lots of money looking for a home. Rates were at all-time lows. And we had more capital than what we could deploy. Like, our investors were like, hey, please find opportunity. And so, like, I'm on the deal side of the business, and Brian's like, Kevin, I'm turning investors away. They're getting upset that I'm literally not, and they're going to go deploy it somewhere else. So what are we going to do? And I'm like, I don't know what to tell you. Like, I can't make numbers work on most of the things I'm underwriting. I'm not going to buy something just to buy it. Right. And so what we found ourselves in was a situation like that. It was like a little bit of a tussle internal. Like, hey, I'm not going through this again. Like, we'll buy what makes sense. And if we can't make sense of it, we're not going to move forward with it. And we actually sold a lot of properties during that period of time because people offered us prices. I'm like, I can't make the underwriting work on this stuff. And so let's exit out. Like, let's get 5 to 7 years worth of returns in 1 year by paying, let them, I know more about than they do, but if they think you do it better, go for it. And so we actually dwindled our portfolio down quite a bit during COVID. And looking back, it was a great idea, right? You sell it to try to sell at the peak if you can time the market, or be fearful when others are greedy, and be greedy when others are fearful, right? Like Buffett said it great, but it's really hard to be disciplined when the frenzy, everyone around you is buying like crazy, right? And so, like, I definitely had a lot of stress during those years because I felt like I wasn't contributing to the organization. Like, Brian was doing his job. He was bringing the capital in. Our name was out there. We're doing great things, but I wasn't able to actually supply enough deals. We were buying stuff, but not enough to the tune of what we could have actually brought in of capital.
Mm-hmm.
And now here we are, rates start going up. We didn't have any adjustable rate debt, and we had low leverage points across the board. And we've slept really well over the past year and a half, where a lot of others have seemingly had really, and I never wish ill will on anybody, right? Like, in fact, I've got personal money invested in deals that are not going well because
me too.
because of just the craziness that occurred, and a lot of people got caught with their pants down. So, but we've slept incredibly well over the past year and a half. It's been a very comfortable time period for us. In fact, it's put us in a position to where last year was our biggest acquisition year ever, in a period where most others it was a complete opposite for them.
Mm-hmm.
We bought roughly $90 million worth of real estate last year because we literally had little to no competition, and we were able to take advantage of opportunity when opportunity presented itself. And that was not the case for me back in 2009, 10, and 11, when everything was at a discount. I was still in damage control, trying to, figure out how to rebuild what I had lost years prior. So anyway, long answer to your question. I think just be disciplined. The fundamentals never change, right? Like, the fundamentals are the fundamentals. Whatever they are to you, whatever is a seemingly good deal for you and makes economic sense and it's going to give you the return you want, don't shy away from that. We go through these cycles. everyone thinks they're never going to end. And as
Mhm.
history shows you, they always end. So
Yeah.
that's
Is
it.
it
Yeah. Just be disciplined and know that like looking back, that 3 or 4 or 5 year span of time is going to seem like a blip on the radar. But what won't seem like a blip on the radar is if you lose everything or if you have a financial crisis that you have to deal with that makes you lose your family, lose your wife, and lose your marriage, lose a business partner, like have health issues because of it, like all the
Mhm.
stress that it adds to your life. It's just it's not worth it. So anyway, I'm very happy with the discipline that I had over the last couple of years for the organization, and we're in a really good spot here today because of it.
So it sounds like a mistake you didn't make because you didn't get carried away with the frenzy and you didn't have any FOMO, a fear of missing out that made you do deals you shouldn't have done.
But it's a direct result of the mistake I feel
The
like I made
mistake you
leading
made in
up
the
to the end
past.
of 2008. Right, exactly. Just kind of learn from that mistake.
But you learned from your mistakes in the past.
That's right.
I've invested in a lot of deals that are not going so well too myself. And one of them was with a guy that didn't learn from his mistakes in the past, went through that same thing in '08 like you did, but then kind of did the same thing again with commercial real estate in the 2020s and is in a bad spot. So I think what you're saying there too is so important of, stick to your discipline, understand that nothing lasts forever,
Right.
and that you've got a long time in this thing too. So you're going to be way better off because of those deals you didn't do. Maybe you missed a couple in 21, 22, 23, when things were crazy, but you're
Yeah, and
still in it.
I think another important point to hit there as it relates to you know just deals that might be going sideways right now, and who knows? I'll see how all it plays out and shakes out. But like I tried to do a really good job of like, performing due diligence on the sponsors and not
Mhm.
just like, hey, what's the last couple of deals you've done? Because everyone's made money over the past like 7, 8, 9 years, right? Like it's been very difficult to actually not make money during the run up. Um, but more specifically, like what type of personal financial state are they in? Like what does their personal balance sheet look like? And like in the event things go sideways, like is the only money they have or money that is money that they made from acquisition fees over the last 3 years? Is that all they have? And that's the only reason they have money? Well, then like that, I'm troubled by that. And I had a challenge with investing in those types of deals. Or are they backed by also another individual? Is there like another, is there a level of hierarchy there where there's another individual that's come in that's got a big balance sheet that's actually, part of their business that's built it up over the last 30, 40 years, and they're the strength behind the organization. They're also the strength to where, things go sideways. They've got the wherewithal and the financial ability to upright that ship. And so
Mhm.
I think that's important because a lot of folks have made a lot of money in the short duration of the last 5, 7 years, but a lot of that wealth was all brand new, and they didn't really. There's not much substance beyond that,
Mhm.
um, and a lot of the money was just made from fees, and so there's not a lot of stability if someone's only got like $1 million or $2 and it's a $60 million multifamily deal. Like if that thing
Mhm.
goes sideways, that $1 million or $2 that they have, and that's all they have, they're not gonna be able to right that ship. But if they got a much bigger backer and there's other people involved that have been through a couple a couple downturns, they've been through a couple cycles, they've got a really healthy, stout balance sheet. Maybe it's a family office, just someone else that has the financial wherewithal to actually, you know, bring first aid to the situation in the event it needs
Yeah.
it.
Yeah. No, that's great. Love it. Um,
Like I've got there's a medical office fund I've been investing in for many years. I know one of the principals. He's one of the younger partners, but the family, literally, the family is a generational family based out of Columbus, Ohio. They've got a huge reputation. Philanthropists throughout the Columbus region, well-known name, names on colleges, things like that, and like their reputation, they would never. I guarantee, just their balance sheet is incredibly strong. And I
mhm.
just from a reputational standpoint, if any of their deals ever went sideways, they would never. I just know for a fact they would never do a capital call. Just from a reputation, they would pull the money out of their own account and actually, write the deal. Just from pure reputation alone, I like that. That makes me feel very comfortable because no one can make perfect decisions every time. Not every
Oh
deal is going to
yeah.
go exactly how you anticipate it's going to go. And but when things don't go as planned, knowing that you've got someone that's behind the wheel they're gonna figure it out one way or another, and they've got the ability to do so.
Absolutely. No, and a lot of people got caught in these rates going up way faster than anybody thought they were going to. So it's nobody's fault. But I like your thought process there too, Kevin. Kevin, do you have a website or somewhere people can find out more about you and about your company, Sunrise Capital Investors?
Yeah, I do. So for the company to learn more about us, what we do, we've got a lot of other resources like historical deals, the case studies on there. You can go to investwithsunrise.com. If you want to learn a little more about me, you can go to you can learn about me there as well. But also I've got a personal website. It's also where I host my podcast, Real Estate Investing for Cashflow. And that's just my name, kevinbupp.com.
kevinbupp.com. And I know, Kevin, you've written a few books. So what are the books you've written?
Just one.
Just one?
So not a few. Yeah, the one right behind me called the
Cashflow
Cashflow
behind
Investor.
you. There you go.
Yeah, there you go. Cashflow Investor. And I mentioned to you, I'd be more than happy to give a free copy out to the audience, a free physical copy, not digital form. I think you just have to pay like $6.99 shipping and handling. But you can grab a free copy of that by going to kevinbupp.com/free book. But yeah, great book. I launched it. I think it's going on 2 years now, but still all very relevant. It's not really a time sensitive information there. And it's really a compilation of both my story, my experiences. I go into detail, even some case studies in there on some historical deals I've done, not just in the mobile home park space, but in other asset classes. But then also, it's my personal story, combined with the many golden nuggets I pulled away from the 1,000+ interviews I've done over the last 10 years of hosting my podcast. I kind of went back through and just pulled out what I felt were just like some of the relevant and just incredibly valuable piece of advice that I've implemented in my own business and put them into that book. So it's a combination of the two.
Love it. And that's a great book. I highly recommend it. I've read it myself. I think I paid the $7 for free shipping. Best $7 I ever spent. So highly recommend that.
Appreciate that.
Kevin, before I let you go, what's a piece of advice you have to newer real estate investors? So what should somebody do if they're just starting to look to get started investing in real estate? Obviously, you started young. Let's say you're speaking to a 25-year-old. What should they do?
Yeah, I mean, it's a great question. I mean, I think focus first and foremost. There's a lot of resources out there, and it's very easy nowadays, like to get overwhelmed because there's so much information floating around. Yeah, and I like to say that. I mean, there's 1,001 different ways to make money in real estate. I love mobile home parks. I like the fact that we, can provide affordable housing and help, provide a solution there. But really, at the end of the day, it really is just it's an investment vehicle. So is parking. It's an investment vehicle. Pick an investment vehicle that you feel aligns with your interest, whatever they might be, and learn as much as you can about it, but put on the blinders, like literally just forget about everything else. I mean, whether it's mobile home parks or office buildings or retail, it doesn't matter, single family, multifamily, pick one, put blinders on about all the rest. Dive in then to only the information on all the podcasts that you can find, but they're only related to that. Just eliminate all the other stuff out of there and just go, search, specific keywords on those topics, listen to that information. But also more important than that is, surround yourself with others that are doing just that. And again, just block out all the other noise and just go deep, don't go wide, and spend a year or however long it takes you to fully understand theoretically the business model and how you can make money there. And again, aligning yourself. I feel like I've always liked having business partners. Some people are kind of, they like rolling solo, and that's their MO. I've always found a lot of value with business partners. I've only ever had one partnership that didn't turn out well after a number of years. Whatever. It wasn't for any reason other than really it was after the crash. So I think it was more financially related than anything else, and distress. But I always found, we're not good at everything. And I think identifying what your strengths are and what your weaknesses are and being self-aware, and then trying to find someone else that's doing what you're doing that might have that complementary skill set that can help you. Maybe you can help you can help them, accelerate the process quite a bit and do more as a team than that of an individual. So again, that's not for everybody. I've found a lot of value. I've always found value in business partners, and it's really leveraging their complementary skill sets and doing it as a team.
I love it. Yeah. So go an inch wide and a mile deep. There's a million ways to make money in real estate. You just got to find one that works well for you.
That's it. Yep. And there's a lot of them. Just find one.
Exactly. Love it. Thank you so much, Kevin. I really appreciate your time here. Everybody go listen to Kevin's podcast, Real Estate Investing for Cashflow. amazing podcast. And make sure you go to kevinbupp.com/free book and download that free book, or put the shipping money up for that free book. All right. Thank you so much. Thanks for coming.